Hello and welcome to the Switzer Investment Strategy Day. Thanks very much for coming along. I do feel as though I'm in the company of friends, and I think, isn't this a fantastic venue to hold something like this? I've never been here before. I've been in some of the smaller rooms, but this is certainly a fantastic venue for a day like today. And as I say, I welcome you for coming along. And I think it's a very interesting time. As investors, I guess it's fair to say that we're a little bit toey about what's going on right now. And I think by the end of the day, I think you'll be in a much stronger position to make your judgment calls on how you want to invest. We conducted this seminar yesterday in Melbourne, and I've got to say I was very impressed with the calibre of the presentations, and I'm sure you will be as well. I read something absolutely brilliant this morning, which I actually wrote. And it was connected to what I heard Janet Yellen say this morning and how Wall Street responded to it. I really feel sorry for Janet Yellen at the moment because she's in a difficult situation. If she came out and said that she believed the US economy was so strong that it could take 4 interest rate rises, the stock market would have actually, I think, sold off very heavily this morning. They wouldn't have believed her economic assessment. Instead, she played a neutral game and basically has withdrawn the idea that America would have 4 interest rate rises, which I think, quite frankly, was a dumb thing to say anyway. Why would you make predictions about how many interest rate rises a country needs until you see the data flow? And that's what she basically said this morning. We will watch the data flow. We're concerned about some of the external developments. She kind of hosed down fears about the US economy, which I think is all quite sensible. End result is the Dow was up about 75 points, I think, in the end. But what I liked in particular was the NASDAQ was up about 0.75%. The NASDAQ is a beneficiary, I think, of this interest rate policy that she's gone for, namely that the US dollar has come down, the Aus dollar has gone up, commodity prices will go up, our stock market should improve. But the mere fact that stock markets hinge on the words of a central banker, that worries me in many ways. I'm not as bullish as everyone thinks I am, and I was saying to one of my subscribers who I know very well that, you know, one day I could change my mind, and when I do change my mind, I'll tell you all. But at the moment, I think the balance of risks still are in favour of being long stocks. As I say, when the day comes for me to change my mind, you guys will be the first ones to hear about it. So, without any further ado, I'd like to introduce to you my esteemed colleague, Paul Rickard. Paul, of course, is a star writer on the Switzer Super Report and also was the former founder and CEO and chairman of ComSec. So I figure he knows a little bit about the stock market. So Paul, take the stand. And Paul's going to talk to us about why we should be investing locally for income. Paul.
Thanks, Peter. I didn't write.
See, I told you they'd clap when you came on.
I didn't write anything brilliant this morning, so I have anything to say about that. And I think also it's a terrific venue, but congratulations for finding it. If you're like me, it's the first time here, but it does take a little while. Look, today is, we really want to sort of break the day into 2 halves. So this morning we're going to look at the income side and this afternoon at the growth side. And Charlie, in a moment, will cover more about our thinking about that. But look, Australia is a fantastic place for income. We have this marvellous thing called dividend imputation. We have high interest rates, we have high yields available in property, we have great infrastructure assets. But the challenge we have is we're a small economy and we're less than 2% of the world's markets, and we'll set up sort of why we think the growth part in many cases is looking offshore. Not to say there aren't great companies that can grow in Australia, but it's just more challenged and certainly there are more opportunities. Let me show you my favourite investment chart, which whenever I do presentations, I wheel out this one. And this is a graph of Commonwealth Bank dividends since it was listed in 1992. First year, paid 40 cents in dividends. It's now up to about $4.28, $4.20. That's a 10, 11-fold increase in dividends. If I go back and take the next chart and compare that to a bond, a Commonwealth Government bond, which you also could have bought in 1992 for about the same term, you wouldn't have got 10%, but I kept the maths simple. It was more like about 8%, and 8% today would seem like a fantastic interest rate. In that first year, you would have got about $50 in interest, but still in 2015, you'd still be getting $50 in interest. Whereas that same Commonwealth Bank dividend is now over $4.20. And that's a fact that people often forget about when they think about the share market. Not just about capital growth, but in Australia, it's partly because we have these companies that think dividends are pretty important and they're able to increase them. And you can get an income-increasing investment out of the share market. And I think that is a fantastic outcome. Forget about the capital price. It's also gone up. It happened to be $5.40 in 1992. Okay, we got to about $95 last year, and it's about $76 today. So 12-fold increase in capital price, more than a 10-fold increase in income over that period of 23 years. And as Peter knows, I happened to buy some at $5.40, so I thank the Commonwealth Bank and their shareholders every day. Now, that's just looking at the income side, but let me move on and talk about dividend imputation, because, of course, what you end up with as an investor is not the gross interest. You end up with what, after the taxman takes his or her take out of it. So really, in thinking about investing, we need to think about our after-tax income or our after-tax capital return. That's what, at the end of the day, matters to you as investors. So let me just quickly recap on dividend imputation and just say why this is such a sensational thing. We've got a simple example. We get a $70 franked dividend in cash, three sort of tax rates, 49%, which is the highest marginal tax rate, 15%, which is a tax rate for people in accumulation, and 0% for those of you in pension. Let's get a hands up. Who's in their super fund is in accumulation still? Yeah, it's about 40%, and in pension, a little bit more. So many of you out there have got a situation where your fund is actually not paying any tax at all. With that $70 dividend comes a $30 imputation credit, and for taxation purposes, the taxable income is $100. Obviously, if you're paying tax at your top marginal rate, you pay $49 in tax. The imputation credit then acts like a tax rebate, meaning the net tax is $19. You actually got $70 in cash, so as an investor, you end up with $51 after tax. For a fund in pension, same $70 in cash, no tax to pay, you get a tax rebate effectively of $30, meaning your after-tax income is $100. And that's the power of dividend imputation. If I just compare that to an interest-paying investment, like a term deposit or a bond, or even for that matter, an infrastructure asset, the same $70 interest, no imputation credits, taxable income of $70, that's the tax you pay at 49%, that's the tax you pay at 0%, the after-tax income is $36, here it's $70. So 51 and 100 versus 36 and 70, and that's the after-tax impact. And that system, dividend imputation, is unique to Australia, right? Doesn't exist in the United States. A little bit of some similarities in New Zealand, but by and large, we're the only market in the world that has that sort of system in place. And that's why I think Australia is a place you look really hard at for income. And of course, we often talk about yields, and people talk about grossed up yield. That's the difference it makes. So you can store the nominal yield, which everyone quotes on the left-hand side, from between 4 and 7%. We're thinking about how they gross up to take effect of something that is fully franked. That 7% becomes 8.5% for a fund in accumulation and 10% for a fund in pension. And I reckon that's a fantastic thing. So for me, Peter, that's how I would just coming back to our agenda today.
Yeah.
That's how I see the whole question of thinking about Australia as a place for income and Charlie will certainly expand on the growth aspect.
Yeah, without a doubt. And it's a strong argument for looking at investing locally for companies that are consistent and growing dividend payers. Paul, thanks very much. Round of applause for Paul, please.